Welcome back to the deep dive. Today, we are wading into, well, what's arguably the single most important economic conflict of our time, the U.S.-China trade war.
It's definitely up there, and it's certainly one of the most misunderstood.
Right. If you just follow the headlines, the story often sounds, very populist. China's cheating, America's losing jobs. We need to fix this huge predatory trade deficit.
It sounds like a really straightforward problem with a simple fix, doesn't it? Target the deficit, problem solved.
Exactly. But that's where today's deep dive comes in. We're looking at the work of Dr. Özgür Kanbir.
Yes, and his analysis really flips that common narrative on its head. He argues the headlines, they're focusing on the symptom, not the actual underlying disease.
So the trade war isn't the core problem.
Not according to this analysis. Kanbir argues it's really an inevitable, quite painful symptom of a much deeper, long-running structural weakness inside the U.S. economy itself.
So it's like the U.S. picked a fight with China when maybe it should have been looking in the mirror.
That's a pretty good way to put it, actually. The core idea we're unpacking today is that the trade war is a reflection, maybe a disastrous one, of a global system centered on the dollar. A system that, well, over the last 50 years or so has just become unsustainable for the U.S. itself.
Right. I remember that famous line from the 70s, John Connolly basically telling the world, the dollar is our currency, but your problem.
Precisely. And Kanbir's work suggests we've moved past that. The new reality is something more like, the dollar is our currency, and uh-oh, now it's our problem too.
And what makes this analysis so crucial for you listening is how Dr. Kanbir reaches this conclusion. He isn't inventing new theories out of thin air.
No, not at all. Instead, he takes several well-known foundational economic ideas, things people have heard of, like the global saving glut or secular stagnation concepts that are often discussed in isolation.
Okay.
And he synthesizes them. He weaves them together into one single, cohesive, and frankly, pretty devastating diagnosis of why U.S. trade policy, specifically the tariffs, failed.
So it's the connection between these known ideas that provides the roadmap.
Exactly. It shows why tariffs were almost, doomed from the start because they didn't address the root cause.
All right, let's get into it. Let's unpack this structural disease. Where do we start? Maybe with the source of the U.S.'s ability to ignore the problem for so long, the dollar's power.
That's the perfect place to start. The exorbitant privilege.
Okay, exorbitant privilege. It sounds almost royal, doesn't it? Coined by the French finance minister Valéry Giscard d'Estaing back in the 60s. Most people kind of get that it lets the U.S. print money, but what's the actual mechanism? How does it work on the U.S. balance sheet?
Well, the mechanism is surprisingly simple, but incredibly powerful. As economists like Barry Eichengreen have laid out, the dollar being the world's main reserve currency gives the U.S. unique flexibility.
How so?
Because so much global trade happens in dollars, and central banks everywhere need to hold dollars, usually U.S. Treasury bonds, for safety and liquidity.
Right, they need them for reserves.
Exactly. This lets the U.S. do something no other country can really do on the same scale. Borrow massive amounts from the rest of the world in its own currency, specifically to pay for imported goods and services.
So the world has this constant need for dollars that creates this huge ongoing demand for U.S. assets, like our government debt. It's like the world is queuing up to lend us money so we can buy their stuff.
That's basically it. This constant structural demand for U.S. assets acts like a permanent thumb on the scale, pushing down our interest rates. That's the tangible benefit of this exorbitant privilege.
Lower borrowing costs.
Much lower. We get to consume imports funded by selling our own IOUs, essentially, and the world's demand for those IOUs keeps our financing cheap. It insulates the U.S. from the kind of market discipline other countries face.
Sounds like a pretty sweet deal, a permanent advantage.
It sounds wonderful, yes, but Kanbir flags it as a sweet poison because it allowed a serious structural disease to fester for decades.
And that disease is this chronic low savings, low net investment paradox you mentioned. That sounds a bit academic. Is there data that shows this?
Oh, absolutely. The source material uses some really stark data to illustrate just how much the American balance sheet has deteriorated over, say, the last 50 years. We need to look at two key things.
Okay.
First, adjusted net national savings. This is crucial because it tries to measure the real wealth building of a nation. It accounts for depreciation, resource depletion.
So what the country is actually putting away for the future, net of wear and tear.
Precisely. Back in the 1970s, the U.S. was saving at a decent clip. This rate was well above 10% of gross national income.
10% sounds pretty healthy. What happened?
Well, over the next 40 years, it just went down, steadily down. The really alarming point was around the 2008 financial crisis. Adjusted net national savings actually dropped below zero.
Below zero. Wait, that means the U.S. wasn't just failing to save. It was actively eating into its existing capital, its wealth, its infrastructure, just to fund current spending.
That's what below zero implies, yes. It's a powerful picture of structural stress. The economy was consuming itself on a net basis for a period.
Wow. Okay, that's one indicator. What was the other one?
The companion piece is net investment in non-financial assets. This measures the actual new physical stuff we're adding: factories, roads, equipment, after accounting for depreciation.
So, are we building more than is wearing out?
And the data here is just as sobering. For about 3 decades, from the 70s through the early 2000s, this net investment rate hovered near zero.
Near zero. So we were basically just treading water, investing enough to replace what broke or wore out, but not really expanding our productive capacity, not modernizing infrastructure significantly.
Largely, yes.
Yeah.
Just enough patching up to keep things going, but not the deep investment needed to really boost productivity or compete globally in the 21st century.
And this lack of investment, does that connect to other economic theories?
Absolutely. This directly links to the secular stagnation idea, which economists like Larry Summers have really pushed. The chronically low net investment suggests a fundamental lack of highly profitable, real-world investment opportunities within the U.S. economy.
Which would naturally lead to slow growth.
Slow growth and structurally low interest rates, kind of regardless of what the Federal Reserve does. The demand for capital just wasn't strong enough domestically.
Okay, so we have this internal picture. Low savings, barely any net new investment, but the dollar's privilege keeps it all chugging along by making borrowing cheap. How does this internal problem create the external symptom everyone talks about, the trade deficit? You mentioned an identity, SICA.
Yes, this is the crucial link, and it's just basic economic accounting. The identity says national savings, S, minus domestic investment, I must equal the current account, CA. Think of the U.S. economy like a household. If our total national savings, S, government, business, individuals combined, are consistently lower than what the country wants to invest domestically, even if that investment level, I, is historically low, well, there's a gap.
S is less than I. Where does the money come from to fill that investment gap?
It has to come from somewhere else,
Bruh.
from outside. The only way for that equation SI to CA to balance, mathematically, is if the current account CA is negative.
And a negative current account means we're importing more goods and services than we're exporting.
Primarily, yes. The current account is mostly the trade balance. So negative CA shows up mainly as that chronic trade deficit that politicians get so worked up about.
So wait, the trade deficit isn't some aggressive act by China or Mexico that we need to fight with tariffs. It's the unavoidable mathematical result of the U.S. saving less than it invests, combined with the dollar privilege letting us finance that gap easily from abroad.
That's the core argument, precisely. The system forces the trade deficit to exist to balance the internal SI gap. It's baked into the structure.
Which means
you can't fix the trade deficit with tariffs unless you first fix the internal imbalance between savings and investment. The deficit is just the necessary release valve for that internal pressure.
Okay, that makes sense. If the U.S. has to run an external deficit because of its internal S minus I gap, the next logical question is, who's paying for it? Who's lending us the money? We must be running an equally large surplus on the other side of the balance sheet, the capital account, right?
Yeah.
Attracting tons of foreign money.
Exactly. And this is where the story pivots to the global stage, and specifically to the world's most effective export machine over the last few decades, China. China became the crucial financial enabler of this U.S. imbalance.
How did that work? I remember Ben Bernanke talking about a global saving glut back in the mid-2000s.
That's right. Bernanke, who was Fed chair then, pointed to these massive pools of savings building up, particularly in export-driven economies like China, but also oil exporters. They were saving far more than they could invest domestically.
And where did all that excess saving go?
A huge chunk of it flowed into the U.S. financial system, looking for safe, liquid assets. This flood of foreign capital pushed U.S. interest rates down even further.
Making it even easier for the U.S.
Even easier, perhaps too easy, for the U.S. to keep consuming heavily despite its own really low savings rate. Foreign savings were essentially funding American consumption.
It sounds like a very codependent relationship. Wasn't there a name for that specific U.S.-China dynamic, Bretton Woods II?
Yes, the Bretton Woods II hypothesis, put forward by economists Dooley, Folkerts Landau, and Garber. They described it as a kind of symbiotic cycle the one with built-in instability.
Huh. How did the cycle work?
Well, think of it this way. China ramps up production, becoming the world's factory, churning out goods to meet America's massive demand for imports demand, fueled by that cheap credit,
Okay, China exports tons of stuff to the U.S.
and gets paid in mountains of U.S. dollars. Now, what does China do with all those dollars? This is the key part. It recycles them. It takes those export earnings and buys U.S. assets, primarily safe, liquid U.S. Treasury bonds.
Ah, so the money flows right back to the U.S. Why was that good for both sides, at least in the short term?
For China, buying U.S. treasuries helped keep their own currency, the renminbi, from appreciating too quickly against the dollar. This kept their exports cheap and competitive in the U.S. market. It stabilized their growth model.
And for the U.S.?
For the U.S., this huge inflow of capital from China kept our interest rates incredibly low, which reinforced the consumption-heavy model. It funded the government deficit, kept mortgage rates down, and basically financed the very imports that were generating the dollars for China in the first place.
Wow. So as a closed loop, U.S. consumes, China produces and lends the money back to the U.S. to keep consuming.
A very powerful loop. And it makes it crystal clear why that huge trade deficit with China, the thing politicians point fingers at, wasn't the root cause of the problem.
Right. It was the result. The inevitable consequence of this whole dollar-centric, low U.S. savings system. The U.S. economy structurally needed that deficit, and China was just the most efficient supplier of both the goods and the financing.
Absolutely. And you can see the dramatic shift in global economic power this system facilitated if you look at the data on export shares.
How did that change?
China's share of global exports started climbing in the 80s. But the really sharp acceleration happened after it joined the World Trade Organization in 2001. That was a game changer.
And wasn't there a key moment after the 2008 crisis? Economic historians like Adam Tooze point this out.
Yes, a really symbolic turning point. Sometime between 2009 and 2013, right after the global financial crisis hammered the West, China's share of global exports actually caught up with and then surpassed the U.S. share.
While the U.S. was struggling, China kept growing its export machine.
Largely, yes. China used massive domestic stimulus to cushion the blow and continued expanding its global market share. That moment really cemented China's position as the world's top exporter. It reflects this bigger shift, the economic center of gravity moving east.
And the trade war, in a sense, was the U.S. trying to use policy to fight against this massive macroeconomic tide it had helped create.
That's a very good way to frame the geopolitical context, yes. The policy was trying to reverse a trend, decades in the making, a trend deeply rooted in these structural imbalances.
But there's a cost now, right? You mentioned the dollar becoming our problem, too. While it's still dominant, the source material suggests that privilege is starting to fray around the edges.
It is, and that erosion is the crucial foreshadowing. If you look at what central banks around the world are actually holding in their reserve.
They're rainy day funds.
Exactly. You see a slow but very steady decline in the proportion held in U.S. dollars. Back in the early 2000s, it was around 71%. Today, it's closer to 58%.
That's a 13-point drop. That's significant. That's hundreds of billions of dollars shifted out of U.S. assets.
It is significant. It's clear evidence of central banks quietly, rationally looking for alternatives, diversifying their holdings.
For a while, people thought the euro might be the main challenger, but then the Eurozone crisis happened.
Right, that damaged the euro's appeal as a super safe haven. What's interesting now, and the source highlights this, is the rise of what's called stealth diversification.
Stealth diversification, meaning?
It means the diversification isn't just into one main rival currency like the euro or even the Chinese yuan, which is growing but still quite small in reserve holdings.
So where's it going?
It's going into a basket of other currencies, things like the Australian dollar, the Canadian dollar, the Swiss franc, Singapore dollar, and that others category has climbed to nearly 10% of global reserves.
So it's not one big competitor, but lots of smaller shifts away from the dollar, euro, and yen.
Exactly. It looks like a risk management strategy. Central banks are hedging their bets, moving slowly towards a more multipolar monetary world.
And the implication for the U.S.?
The implication is that the U.S. needs to prepare for a future where that exorbitant privilege might not be quite so exorbitant, where market discipline might start to bite harder on its domestic finances.
Okay, so let's recap the diagnosis. A deep internal problem in the U.S., low savings, low investment, the SI gap. This was enabled by the dollar's global role, the exorbitant privilege. And this internal gap had to manifest externally as a chronic trade deficit, which, for various reasons under the Bretton Woods-Second system, was primarily filled by China.
That's the structural backdrop.
Then comes the political response in Washington. America first. Protectionism, tariffs. We saw the first big wave in 2018, then escalations. The source material suggests the average effective U.S. tariff rate climbed above 17%.
Yes, over 17%, which is historically quite shocking. That's the highest average rate since the infamous Smoot-Hawley tariffs of the 1930s.
Which many argue worsened the Great Depression.
Indeed. But the populist logic for these new tariffs was simple and frankly appealing to many. Make China pay, revive U.S. industry, shrink the trade deficit. It was presented as using leverage to force change.
But the core idea that China will pay for these tariffs, how did that hold up under economic scrutiny? Did China actually absorb the cost to stay competitive?
Well, that was the claim. But the economic analysis, including from U.S. institutions, found something entirely different. The studies showed what's called a near 100% full pass-through.
Full pass-through, what does that mean?
It means the cost of the tariffs was almost entirely passed on to the importers in the U.S. The landmark research found that the cost of the 2018 tariffs was, and I quote, fully borne by American firms and consumers.
So Chinese exporters didn't lower their prices to offset the tariff?
The studies found no statistically significant evidence that they did. So if the U.S. government put a 25% tariff on a product coming from China,
the price of that product at the U.S. port basically just went up by 25%.
That's what the evidence indicates. The U.S. importer and ultimately the U.S. consumer or business buying that product paid the tax.
Hold on. That completely undermines the central political argument for the policy. If the goal was leverage, and China didn't cut its prices, then the U.S. is just taxing itself. Are you saying this huge disruptive policy achieved almost nothing in forcing China to adjust its pricing?
On the pricing front, the evidence suggests very little impact, yes. And it makes sense when you think about the structural dependency.
Yeah.
The U.S. didn't have the domestic manufacturing capacity, remember that, near zero net investment, to just immediately switch suppliers for many of these goods.
So the cost got passed down the chain to U.S. households and businesses.
Correct. The source confirms this. It often landed squarely on the American consumer.
Do we have specific examples? That sounds like it could add up. You mentioned a figure earlier, $1,300 per household.
That was the projected long-term cost based on the tariffs implemented and planned, yes.
Mm-hmm.
And we have concrete examples, too. The analysis of washing machine tariffs, for instance.
What happened there?
Prices for imported washing machines jumped by about $86 per unit soon after the tariffs. Dryer prices went up by about $92. The total cost to U.S. consumers just from those appliance tariffs was estimated at over $1.5 billion. And beyond the direct costs, independent economic models projected that these protectionist policies would actually reduce overall U.S. GDP. The source cites a figure of about 0.8% lower GDP in the long run. That's a net loss for the U.S. economy. It's hurting the patient, not just the disease.
Okay, so the tariffs hurt U.S. consumers and the U.S. economy overall, but did they at least achieve the main stated goal, shrinking the total U.S. trade deficit?
This is where the evidence of policy failure becomes crystal clear. The answer is a resounding no. Instead, we saw a classic economic phenomenon called trade diversion.
Trade diversion, meaning the trade just went somewhere else.
Precisely. The tariffs failed completely to fix the underlying structural problem, that S-I gap. So the overall deficit didn't shrink, it just changed its address.
How big was the shift?
The numbers are really striking. If you compare the U.S. goods deficit from, say, 2015 to 2024, a period covering the trade war's implementation, something remarkable happened. Yes, the deficit with China did decrease by over $71 billion.
Okay, so it worked on China specifically.
It appeared to, on the surface. But, and this is the crucial part, the U.S. total goods deficit with the entire world actually exploded. It increased by a massive $459 billion over that same period.
Wait, the deficit with China went down by $71 billion, but the total deficit went up by $459 billion. That's incredible. The problem with the target country got a bit smaller, but the overall problem got vastly worse.
That's what the data shows. The deficit just shifted massively to other countries.
Where did it go? Who are the winners, so to speak?
The biggest beneficiaries in terms of absorbing that redirected U.S. deficit were Mexico and the European Union. The U.S. deficit with Mexico surged by over $111 billion. The deficit with the EU jumped by nearly $80 billion.
Why them?
It makes sense. U.S. companies needed imports. If Chinese goods became too expensive due to tariffs, they looked elsewhere. Mexico's right next door, part of existing supply chains thanks to trade agreements. The EU offers sophisticated manufacturing. Businesses simply rerouted their sourcing and production.
So that's the ultimate proof, isn't it? Tariffs are just a border measure. They change who we run the deficit with, but they can't eliminate the deficit itself if the underlying reason consuming more than we produce and save doesn't change.
Exactly right. That S-I gap has to be financed from somewhere externally. If you put up a barrier to financing from China, without changing the domestic S and I equation, the financing just flows in from the next available source. The imbalance remains. The overall deficit actually got worse.
And this whole episode, this turn towards protectionism that didn't really work and cost U.S. consumers, it also had broader global effects, right? It accelerated this trend people call globalization.
Yes, it absolutely did. The trade wars injected a huge amount of uncertainty and friction into global trade, which is already kind of slowing down after the 2008 crisis anyway.
Companies got nervous about supply chains.
Very nervous. Seeing trade policy become so volatile, many started rethinking those long, hyper-efficient global supply chains. Maybe bring production closer to home or diversify suppliers. This pullback definitely contributed to the slowdown in globalization.
Do we have numbers on that?
The source notes that the share of global trade relative to the world economy dropped significantly by about 7 or 8 percentage points just between 2017 and 2020. The tariffs didn't solve America's internal problem. They just helped make the whole global trading system less efficient and more fragmented.
This really brings us to the core intellectual contribution of Dr. Kanbir's analysis that we wanted to focus on. We've talked about exorbitant privilege, global saving glut, secular stagnation, trade diversion, Bretton Woods II. As you said, these aren't brand new ideas in themselves.
No, they've been part of the economic discourse for years, some for decades.
But Kanbir's work, as you described it, isn't about inventing a new ingredient. It's about how the ingredients are combined. You used a chef analogy, taking known things like flour, sugar, eggs, but creating a unique, structurally sound cake that hadn't quite been baked that way before.
That analogy is really spot on, because the real strength, the academic contribution here, lies in the synthesis. It's about connecting the dots in a specific, powerful way. We can actually list the known ingredients, the existing theoretical building blocks he uses.
Okay, let's tick them off. First, the foundation. The exorbitant privilege of the dollar. Aishan Green and others detailed that extensively.
Right. Second, the money flow. The global saving glut. Bernanke's 2005 hypothesis explaining the capital rushing into the U.S.
Third, the U.S. domestic situation. Secular stagnation, which Larry Summers really brought back to prominence around 2014, explaining weak domestic investment.
Fourth, the policy result. Trade diversion, a concept going way back to Jacob Viner in the 1950s, explaining how trade just reroutes around tariffs.
And fifth, the specific U.S.-Asia system, the Bretton Woods theory framework, described by Dooley, Folkerts, Landau, and Garber in 2003, showing that U.S.-China codependency.
So yes, all those pieces were out there. The truly original contribution, the unique recipe, if you will, is how Kanbir constructs a specific causal chain linking all 5 directly to explain the failure of the U.S.-China trade war.
Can you lay out that chain again?
It's this sequence. The dollar's exorbitant privilege allows the chronic low U.S. savings investment gap, SI. This internal gap mathematically necessitates a current account deficit, SICA. This deficit manifests most prominently as the trade deficit with China under Bretton Woods II dynamics. Therefore, using tariffs, trade war, to fix the deficit with China must fail because it doesn't address the root SI gap, leading only to trade diversion.
That specific chain, connecting those 5 elements in that order to explain this specific policy failure, that's the novel part.
That's the core argument for its originality, yes. That particular synthesis, that structured diagnosis applied to the trade war, hadn't been laid out in such a cohesive, integrated way before in the literature.
But surely other prominent economists weighed in on the trade war. People like Kriegman, Stiglitz. Didn't they criticize it?
Oh, absolutely, many did. But their analyses, as the source material suggests, were often more fragmented. Partially analyzer, as it's termed in the original context. They focused on parts of the problem.
How so? How is Kanbir's synthesis different?
The crucial difference is the systematic integration of 3 dimensions that are usually treated separately in economics.
Okay, what are the 3 dimensions he brings together?
First, the monetary system dimension. He doesn't just mention the dollar, he makes its privilege the absolute linchpin, the enabler of the whole structural problem. It's not a side issue, it's central.
Got it. Dimension 1, dollar's role.
Second, the macroeconomic imbalance dimension. He uses that fundamental SICA identity not just descriptively, but to show the deficit is a structural necessity flowing from deep-seated U.S. domestic patterns.
Dimension 2, the internal SI gap math.
And third, he links these directly to the trade policy dimension. He shows why protectionism was bound to fail, trade diversion, and calculates the domestic cost, demonstrating the policy's ineffectiveness because of the first two dimensions.
So monetary system, macro imbalance, trade policy, all explicitly linked in one causal chain.
Exactly. And if you look at other major analyses, well, take Krugman or Stiglitz, they definitely highlighted the costs of tariffs to consumers, the damage to alliances, the general folly of protectionism, very important critiques.
Huh.
But they didn't typically place the dollar's unique role, combined with that internal U.S. savings investment gap, as the foundational reason why the trade war itself was happening and why it was structurally doomed to fail in fixing the deficit. They focus more on the immediate costs and consequences, less on this specific synthesized root cause. Kanbir is digging deeper into the why based on this specific linkage.
What about others, like maybe Martin Wolf or Donny Roderick, who write a lot about globalization's problems?
Again, incredibly valuable work on the contradictions of globalization, the rise of populism, the risks. But typically their analyses didn't center the dollar's reserve status, tied directly to the U.S. SI imbalance, as the core mechanism driving this particular trade conflict.
Even reports from places like the IMF. They must have seen the trade diversion data.
They absolutely documented the trade diversion, showing the shift from China to Mexico, the EU, Vietnam, etc., meticulously. But those reports often stop short of explicitly connecting that diversion back through the SICA identity to the U.S.'s own internal structural deficit, and the dollar's role as the ultimate permissive factor. They described the symptom, but didn't always integrate this full causal chain diagnosis back to the U.S. domestic structure.
So the real scientific value here isn't a new discovery, it's the power of the synthesis, bringing these different strands together.
Precisely. It offers a unified, multidimensional framework. It draws on the strongest insights from international finance, dollar privilege, macroeconomics, SICA secular stagnation, trade theory diversion, and even political economy, Bretton Woods dynamics, to provide a much more complete picture.
Moving beyond just saying it's geopolitics or it's unfair trade.
Exactly. It avoids those single-angle explanations and presents a structural diagnosis. The stark conclusion is that the U.S. trade war wasn't primarily about China. It was fundamentally an expression of America's own internal economic imbalances projected outward. And the policy tool used, tariffs, was mismatched to the actual problem. #outro table.
So to really bring this all together, the central argument we've unpacked today, based on Dr. Kanbir's synthesis, is that the U.S.-China trade war was fundamentally a political reaction to a deep-seated American macroeconomic failure.
That's the core takeaway. The internal structural weakness, that chronic gap between low savings and low investment, created the vulnerability.
And the dollar's exorbitant privilege was the enabler. It allowed the U.S. to essentially ignore that vulnerability for decades because the rest of the world was willing, even eager, to finance the resulting deficits cheaply.
But that privilege, as we discussed, became the sweet poison. And the trade war, with its noise, its disruptions, its costs passed on to American households and businesses, its ultimate failure to fix the overall deficit that was really just a loud, painful confession.
A confession of what?
A confession that John Connolly's old line has completely flipped. The dollar is no longer just your problem. The dollar and the imbalances it enabled is now very much our problem too. America's problem.
And the key insight for policy is that you simply cannot fix a fundamental savings and investment imbalance using tariffs at the border.
You can't. If S is structurally less than I, the U.S. must import capital and run a current account deficit. Tariffs just change who finances it. They reroute the deficit, they don't eliminate it, as the trade diversion data clearly showed.
Which leads us to the final, quite provocative thought we wanted to leave you, the listener, with today.
We talked about that data showing the slow, steady decline in the dollar's share of global reserves, that stealth diversification by central banks. It suggests the world is gradually, cautiously moving towards a more multipolar currency system.
Okay, so what happens if that trend continues? If the U.S. loses even more of its exorbitant privilege? Those super low borrowing costs the U.S. has enjoyed for decades, essentially a global subsidy, they might start to evaporate.
That's the critical question. If the world becomes less willing or less able to automatically finance that U.S. SI gap on easy terms, what happens then? the U.S. will suddenly face much harsher market consequences for its low savings and high consumption patterns.
So the final question for you to ponder is this. If that external financing cushion disappears, or even just shrinks significantly, what difficult, perhaps politically painful domestic policy choices will the U.S. finally be forced to confront? Choices about boosting national savings, making tough fiscal decisions, maybe finding ways to stimulate productive domestic investment. What will it take to finally close that structural SI gap from within when the rest of the world is no longer willing to paper over it so easily?
That's the multi-trillion-dollar question for America's economic future in what might be a post-privileged world.
Welcome back to the Deep Dive.